Okay, we have a question from Mohit. A financial advisor suggested that I invest in a quote-unquote investment engine with death benefits instead of a backdoor Roth IRA.
What could that be?
I did some digging, and it appears this is an indexed universal life insurance policy that says it tracks the market. Is this a good idea?
So Mohit has run into someone who said, hey, I've got this great solution for you. Instead of investing in a Roth IRA, those stinky old things, let's put you in something where you can mimic the market, but when you die, there's still a benefit for you. And what do you say his was? A universal index life insurance policy, something like that.
It's an equity. It's one of the ratchet it up without the risk.
So I don't want to speak. I'm going to speak sort of vaguely, right? There are tons of products that are wrapped inside of insurance-based products where you have some sort of investment component, and we've done countless shows on the ins and outs of those, how they work, I'm going to give you sort of the Bo Hansen big overview of what I don't like about it. I don't like when you combine financial products, because I think when you start combining them, neither of them can do the thing that they're supposed to do really, really well. So when you combine, like life insurance is supposed to be there when you die. So what do I want when I buy life insurance? I want the maximum amount of money to go to my family at the lowest cost to me while I'm living. That's what I want. What do I want my investments? I want the maximum amount of growth over the longest time period possible. When we end up putting those together, what you get is a subpar solution on both fronts. You get really, really expensive life insurance and really, really expensive, poor performing investments. So I am of the opinion, let your insurance be insurance and let your investments be investments. And in my experience, when we do that, we often find ourselves in a better position. We do the things like buy term and invest the difference or whatever the thing may be. I really love doing it that way. You agree, disagree, think it's more nuanced than that?
No, I mean, this is, here's something that I think is, I'll do a little story time.
Everybody buckle up.
No, it won't be that long, because there was, back when we were in Georgia, there was a Chick-fil-A that it was a Truett's, because it had a counter service. There was let's just call him an insurance representative, who would hang out in the Truett's and basically just befriend anybody who walked in. And we got somebody came in through our doors that was a widow, that a recent widow, and she had gotten a hold of this person, and he loaded her up in 2 of these equity index type products. On the brochure, here's why these things sell so well. I'm just going to share this. You have to do your own due diligence on it. They tell you they can get what the stock market does without the risk, because they don't, on the years the markets are down, it's like a ratchet. It doesn't go down, it just ratchets up only. They'll even use that in the sales brochure. But what I didn't like, and fortunately, these things have so much issue that they actually have a period that you can return them and get your money back. Fortunately, I mean, this is you got
a little bit of a red flag right there.
You ought to have to know that anything that has a look back period probably means that there's a high sales force that the government has stepped in and said, yeah, okay, we're going to let you have this sales force do it, but there's going to be a look back where you can surrender it and it'll be like it didn't happen. Here's what I don't like that they don't tell you in the sales brochure. Participation rate. They usually gut those returns. They'll cap you out somewhere between 7 to 9%.
So if the market has a 28% year, you might make 7%.
A lot of your long-term compounding comes from those mega years. Those years where the market gets crushed and then it has its quick recovery and makes 20, 30%. If you're locked down at 7%, you can quickly see that you missed out on years worth of compounding. There's a reason they put that participation rate and limitation there. The other thing I don't like is, and this is where it hit this widow that I was dealing with, the surrender and back-end fees were horrible, because there's a reason they can also offer a guarantee, because that's not something that's offered very easily in the financial world, is because that they lock your money up for 7 to 10 years typically.
And sometimes even more, but yeah.
They will give you access either in 5% or 10% increments per year. But if like this client had some medical things coming up, and because they're a widow, a little bit older, and I was like, you realize you're gonna have to burst that policy just for your upcoming cash flow needs. I can't believe this insurance agent didn't. And believe me, when I called the home office to take this policy back, they got very embarrassed when I brought up all the reasons, because I did this call with the client at the time. That blows my mind, and I kind of fall back onto what Bo was talking about, is that I love insurance. I mean, because I think that there's definitely a time and a place for making sure that you're protecting yourself from catastrophic type things, whether it's disability, whether it's death. You do need to have coverage on that type of stuff, but that's different than investing. So, let's isolate those things, because I have found that most things and products aren't good at everything. Let's find somebody, let's get the best of the class on everything we do. I've told you how much we love index investing. I told you how much we love term life insurance, and we love buying disability. Why not go get industry leaders in each of those categories instead of getting something that's lukewarm, that probably isn't going to serve your purpose in a purposeful way, except for the person that sold it to you? I bet if you ask them how much they make off of it, if you saw the number, you might be a little surprised.
Can I just say one other thing? I know this question is going to go a little bit long, but maybe you have someone in your life saying something along the lines of, well, yeah, but wealthy people invest in insurance products. Wealthy people do that. This is a solution for wealthy people. Wealthy people. As two guys here who literally work with wealthy people for a living, it is true. A lot of wealthy folks do use insurance products as a means and a mechanism to serve a specific purpose. Maybe they have businesses, or they have illiquid land, or there's some reason that they have an estate tax purpose. It is a very small percentage of folks that actually end up having to do that. Well, then you get this thought, oh, well, maybe these people, they build it up and they borrow from themselves. That right there is a premise of itself that I can't get over. Why on earth, when I'm trying to build financial independence, when I want to be beholden to an insurance company, I have to borrow money from myself, and the only way that I kind of win in that scenario is if I die, right? Like if I die before the money runs out, or I got to start putting money back into it. I think a lot of people, because they're complicated and they're difficult to understand, it's just putting this black box of, this is what wealthy folks do. I don't know that I would agree with that.
Yeah, I just, I know we'll take some flack because we do have some really good insurance people that follow us, and they'll be like, guys, I wish you wouldn't pick on. But I would just tell you, make sure that when you're doing the due diligence with your clients and your prospects, that you actually are doing what they need, because that's the big thing. I think if your business will flourish if people can tell you're not selling product, that you're actually trying to be a technician and giving people the guidance that they need.